Watching Asia first, in Greater China markets opening with huge losses, tracking their Asian peers amid growing fears of a global trade war. The Shanghai Composite tumbling by more than 5%, Shenzhen Component falling by a greater 7%, and the Hang saying they're nearly 9.5% in the red, with the Chinese listed tech firms weighing on the benchmark. Let's take a look at some names in particular. Alibaba is more than 10.5% lower. Baidu nearly 10% in the red. Insurance sector shares, those are also leading the declines at the moment, with Prudential down by more than 12.5%. And a reminder of how other Asian markets are faring this hour as well. Nikkei 225, 6% lower. Singapore's STI also about 6% underwater. The benchmark index here, in fact, had plunged as much as 8.7% earlier, which would then make it the most since October of 2008. Taiwan's TAIEX nearly 10% in the red this hour. And we're joined by Mahesh Sethuraman, a Singapore CEO at Saxo. Mahesh, thanks for coming in. And of course, this is quite an unexpected morning, as we were just talking about. So it's grim as well for Hong Kong and China coming back from that holiday. I mean, are we even near the bottom at this point?
I mean, it's impossible to say, right? It's a pure liquidation move. It's impossible to figure out what's going to work and what's not. And it's prudent not to kind of take an active sort of decision at this point of time. Just sit tight, allow for the panic to play out. It's pure panic move, right? If you look at gold, I mean, who thought gold would correct in a market like this? But that's because everybody's selling off everything, because there's liquidity crisis, right? Even if I am bullish gold, but if I have a margin call on my equities, the only way I can service it is by selling gold. So it's important not to read too much into this panic move, but at the same time, stay tight and survive and wait for greater clarity to emerge.
Okay, so this is purely, the feeling, panic. But I wonder if it's enough to move, major economies to take some action. I mean, for China as well, the yuan continuing to slip. And over the past few sessions, we're hearing, growing talk of Beijing possibly allowing the yuan to depreciate. And I wonder if that could be something that they could do soon, and odds of that happening, and what it means for greater volatility in the FX space.
It's interesting, right? In fact, that would have been my first expectation. On the day when Trump announces, I would have expected China to sort of allow yuan to depreciate. The fact that it's not happened to the extent that it should have tells me that China wants to wait and watch how this plays out. And to be honest, nobody expected, first of all, the scale of this tariff, and also the logic on which it's built is so flimsy, because this is not really reciprocal. It's a question of the scale of your trade deficit with US, which doesn't make too much sense. I mean, I don't want to mince my words. This is one of the greatest self-inflicted catastrophes in terms of policies in the world, and I hope that there is some sign of backtracking from the US. At the moment, there's not an obvious sign. They're trying to double down. So my guess is Europe and China are sort of announcing some retaliatory measures, but at the same time hoping that there'll be some signs of backtracking. If we don't see that, if this is set to continue, I think yuan devaluation is a given, and that's the best sort of policy measure China has to cope up with the tariffs imposed on them.
So right now, it's just kind of a war of words at this point, but whether the action actually, is put into place, it depends on whether, we see the US backing down a bit. They also talk that, we could see China deploy other tools, including triple R cuts as soon as this month. Is that also something you think may not happen unless, we see, US, of course, continue to double down on their tariff stance?
I mean, that's tricky, especially given the moves this morning. Forget triple R cut from China, which could be a more sort of medium-term policy measure. I mean, right now, the way assets are moving, I mean, it's a matter of time before Fed comes in and cuts rates out of turn. And that's how serious the implications of the market moves last week and particularly this morning are. Again, RR cut is certainly on the cards, but that's more as a medium-term measure. You could have some dramatic liquidity measures from all the central banks around the world sooner if this continues and US doesn't backtrack.
Okay. Now, rest of Asia also really just a bloodbath, as we've been tracking Taiwan also nearly 10% lower. And over previous sessions, we've actually talked about how US exceptionalism that's fading, and then investors are looking elsewhere, Europe, Asia as well. Yeah. And I wondered if that still holds, given how jittery, how fragile, the rallies have been, and this just really proves it.
No, it probably holds all the more, right? Even before the tariff war was launched, the fact that Germany was looking up, the fact that they're going to sort of let go of their debt constraints was super positive for Europe and particularly Germany. And the fact that China is showing signs of growing, plus the fact that the valuation is super attractive, and the fact that the government is kind of announcing closer collaboration with tech entrepreneurs was all positive signs. So even before the trade tariff, the case for diversifying away from US and into Europe and into China was pretty strong. And now, especially on the back of these tariff measures, it is imperative that investors are trying to spread their bets wide and try to, it's not prudent to reduce your allocation to US dramatically, but it makes sense to consider, moving away from US for the incremental investments as we go along.
And one more thing that is also quite striking this morning is that commodities didn't really offer any comfort as well. WTI under 60 a barrel. Gold is tumbling. And as you pointed out earlier, we talk about gold prices rising in the lead up to those tariffs, but it's reverse course now. Really, what do you make of this?
The crude is understandable. I mean, this is, I know there is a risk of inflation because of tariffs, and especially in the US, but that's a one-step change. If I were a central banker, I would be more worried about growth than inflation. Sure, there will be a short-term inflation, but eventually it's going to lead to a dramatic break in consumption, and that is not good for US economy in particular and global economy at large. So the recession risk is way more than the inflation risk, and that's clearly reflecting in some of the commodity prices, copper, crude, and so on. Gold is a bit of an exception. In an ideal world, gold should be rallying on the back of such massive geopolitical moves, and the only reason why it's not moving, at least according to me, is because people are funding their margin calls. It's a pure liquidation move where they're selling everything. My view is that if this trade war is set to continue, even after US dials back a little bit, gold should be structurally sound as a diversifier.
Right. And just talking about, inflation and the odds of recession and growth in the US. So the US Fed obviously has an inflation mandate. But could the threat of recession outweigh that? And we're really seeing growing bets that the Fed could cut rates as early as May.
Yeah.
Your expectation on what we could see then?
I think so. I think the odds of Fed cutting, today morning the market is pricing close to 5 quarter basis points cuts, which is already a dramatic change in pricing. But again, the pace at which it's moving, and historically, a move of this size, what happened last week and particularly what's happening this morning, we could see even an out-of-turn Fed cut, if this continues. So it's not just about May, it could be even sooner than that if situation continues this way.
An out-of-turn Fed cut meaning the emergency cut?
Something like that.
And that would spell a lot more trouble for the market, because the only reason why you would deploy an emergency cut is because of an emergency. So
it is. Given the way market moves have happened last week, and particularly this morning, there's a clear sign of the fact that the market is panicking. And what we grossly underappreciate is that a lot of the assets are correlated, and we're just coming off the back of a massive AI wave, where a lot of the funds, a lot of the investors are heavily into AI names, and they're correcting massively. This could lead to a systemic crisis if this continues. Apart from the economic crisis, this could lead to a financial crisis if this is allowed to fester. I don't think Fed will act that soon, but I'm just saying if the scale of the moves that we've seen this morning plays out over the rest of the week, we could even see an out-of-turn emergency liquidity injection from some of the central banks around the world, including Fed.
Right. And we enter earnings season on Friday. Starting with the big banks. What are you expecting to see? And as well as guidance, right? That's very important as well. Most people are looking out for, and also for the big tech names, which have already been kind of, struggling a little in the lead up to those tariffs. So what could we see in this Q1 earnings season?
It would have been an interesting earnings season if not for the trade war, right? Everybody was talking about the fact that the US exceptionalism is slowly fading. There are signs of slowdown, and this could spell trouble for some of the margins of the big US names. But again, right now, none of that matters. Right now, it's a trade war which is at the central attention of the markets, central attention of the political and economic space at large. And I don't think earnings season is going to be as crucial as the fact that this trade war has to de-escalate first. And if it doesn't de-escalate, even if you have a superlative earnings season, it's not going to matter too much, to be honest.
All right. We appreciate your time and your insights this morning, Mahesh. Mahesh Sethuraman there. He is Singapore CEO at Saxo. And of course, we have more coverage of the impact of President Trump's trade measures in a special CNA correspondent podcast. Arnold and I, we explain how tariffs work and sort through a range of global reactions. You can catch that on our website, cna.asia, or Me Listen apps. You can also find it on Spotify and Apple Podcasts.